Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Tuesday, December 19, 2017. We're looking at a daily chart of the SPY or SPDR, which is the proxy for the S&P 500. And we finally had a little bit of a down day today. We had a huge gap up yesterday, and what today did was simply retrace a portion of the move from yesterday. It's common and normal market behavior. Of course, if you listen to the media, it's all about the tax bill and this, that, and the other thing, and everybody's always looking for an excuse why the market was down. The reality is the market's up so much that you don't need an excuse for the market to be down 0.4%. The S&P 500 cash index was down less than 9 points. Yesterday it was up a lot more than that. This is a simple garden variety retracement. So let's talk about where we go from here. Assuming they passed the tax package in full, and they passed it through the House today, and I believe it goes to the Senate or whatever the deal is. I'm not exactly 100% sure exactly how it works, but I think it's expected to be on President Trump's desk, at least if not tomorrow, at some point during this week. Let's assume that that passes. There's a number on the chart. You can see a horizontal line running across the screen at 266.25. Maybe it's 266.50, the actual gap fill, where there's a gap left open from the 15th to yesterday, which was the 18th. That's the gap fill area. That's officially at 266.51. I have the number at 266.25. Let's just assume it's a 25-cent spread in one direction or another. That's where I believe the market wants to get to, because it, A, wants to fill the gap left open from Friday to Monday's trading. The reality is we're in a overbought condition, and all the market's doing, and I say this each and every night, all the market's doing is working off some of the overbought condition, letting the 20-period moving average, which we also call home base, move up into price, or let price move down toward home base. Either way, it's eating time off the clock and resetting some of the overbought condition. Nothing more, nothing less. The perfect recipe for that to take place is the gap fill area that takes place from the gap left open from Friday's closing price. Now, if the market should have a deeper break by chance, then the interesting and important number happens to be 265.39. Any close below 265.39 will be extremely important to this market. That will coincide with in and around about the 20-period moving average. It's also the low from Friday. And if the market closes below that level on a daily close, then we could see some more downside activity, and that's where the 262.75, this trend line running across the screen, would come into play. But barring that, I don't think we get there. I think the market fulfills the gap. I think we get down to 266.50, 266.25, maybe as deep as 266, and I think that's where the market finds some semblance of support, which will also be sufficient for a reset from a short-term overbought condition. Remember, we're getting into the holiday season. It's unlikely that we have any kind of a trapdoor opening in this market, having the market or the S&P fall through for 50, 75, 100 S&P points. I don't think that's the likely scenario. Anything is possible at all times, but at this point in time, at this time of the year, it's certainly low down on the totem pole of probabilities. When we look at the IWM, it's much of the same story, although the IWM was certainly down more than the SPDR today. The S&P 500 was down about 0.4%. The IWM was down almost 1%, about 0.9%. And as we know, the IWM is my favorite leading market indicator. It leads on the upside, leads on the downside. So there's a couple of important things that we want to take note with the IWM that may be a tell or telling a tale of something to come. So we always want to be aware of both sides of the market. We want to be aware of the bullish side. We want to be aware of the bearish side. Now, the IWM is not necessarily telling the same story as the Dow and the S&P in terms of new highs and just a pullback today. So the IWM had a pretty good down day. It's a reversal candle from yesterday. We had a huge gap up yesterday, and today we basically gave back a lot of the up move from yesterday. Not all of it, but we gave up a lot of it. Now, this is a reversal candle number one, so that's bearish. That means there's more downside. However, here's a gap here, and that's the likely place we're going. Maybe we go down a little bit farther into the 20-period moving average. That's certainly possible, and there's no damage done at that point in time. As you can see, we're still above this upsloping trend line. We'll get to that in a second. That's drawn over from the monthly chart, and that's been in place for several years. As long as we close the month of December above that line, the IWM, or small cap index, Russell 2000, remains in the most bullish stance it can. But here's where we want to raise the caution flag. Technically speaking, this is a down move and a bearish wedge pattern, and this will generally play out to the downside. Now, this can actually complete down here and reset itself and then go higher after the fact. So maybe we have a couple of bad days for the IWM, but I don't see the IWM getting much lower than this upsloping trend line and or around the 50-period moving average or this pivot low down here that comes from the 14th of December. So technically speaking, this bearish pattern will actually be intact until and unless we close above the high that was made in the IWM, and that high took place on the 4th of December. So until and unless we close above the 4th of December high, this bearish pattern is technically still intact. But let's take it a step farther and take a look at what we have on the weekly chart. So it's the same bearish pattern, but there's nothing wrong with this market. This market is in a strong uptrend, and you can see as long as we're above this upsloping trend line, then all is good, and there's nothing technically wrong with the IWM. This upsloping trend line comes over from the monthly chart collecting, or connecting, I should say, the low from October of 2011, another low in November of 2012, another low in October of 2014, and then you can see that we tested from the underside that trend line, failed. We had a pretty good down move, and that took place in 2016. And then we've been in an uptrend ever since. We hugged this line for a while, and then we finally broke above and closed above this line, putting the IWM in the most bullish stance it can. Why do I spend time on this, and why do I think it's important? Because I think that the tax bill is best suited for corporations and, in large part, small business across America. Now, it's going to be good for big business, but big business either makes a lot of money or they don't, and it doesn't really move the needle. Maybe it will help to bring back some money into the economy that's being held offshore. That's certainly a fact. However, I don't believe that big business is going to be taking the money they save from taxes and reinvesting it in plant, equipment, and people. I don't think that's going to happen. What I think is going to happen is the more likely scenario on where money comes back to the economy is from small to medium business across America. If small and medium businesses can actually save money by paying less taxes, I do believe that that money will get put in to use in some cases into those businesses for expansion. Small businesses have an easier time expanding. It's easier to move the needle in a small business, or the money goes back into the pocket of the principals of the business or the ownership of the business, and it comes directly back into the economy in a number of different ways. Some of it gets saved, some of it gets spent in the economy, and some of it gets invested in markets. And that's good for America, it's good for the economy, and it's also good for the market. And that brings me back to why I always cover the IWM and why I think it's so important, because I think it's an extremely important gauge of the U.S. economy. The IWM rallying in the face of this tax bill or the ensuing tax bill was an indication that the tax cuts are good for small business in America. And it's just that simple. You don't need to read any deeper into it than that. The market always tells the story. The question is, are we able to read what the charts are telling us? And here in the IWM, the way I'm reading it is the tax cuts are good for small business. That's simple. All right, got off on a tangent. Let's get back to center. We'll take a look at the transportation average. Up slightly today, not a whole lot, up about 13, 14 points. But again, we're on a breakout. We're obviously overbought, but markets can stay overbought longer than most people realize they can. And it's also a bit of a divergence. As you know, my two favorite leading indicators are the IWM and the transports. And the transports were positive today. The IWM and the spiders and the Dow and most of the other indexes were down today, and the transports were telling a different tale. We can't make much out of it right here, right now, today. But what we do know is that the transports remain strong, and the transports are another great indicator of what the economy, or I should say what the charts are telling us the economy is expecting. And the economy is expecting growth in the near term, and that's why you're seeing the transports do well. Why is that? The transports are railways, the transports are UPS, the transports are FedEx, they're trucking companies, they're the companies that move goods across the country and across the world. If those companies are doing well, that's the market way of telling us that it's anticipating growth in that sector, and if there's growth in that sector, that's meaningful to an expanding economy, and it's the chart's way of telling us that the economy will continue to expand, and therefore the market is likely to expand as well. The last stock market related index we'll look at tonight is the broker-dealer index. We can also use the XLF as a gauge. The XLF looks very similar to the broker-dealer index. So we were down about 0.5% today, 13 cents in the broker-dealer index. But what I want to point out is there's nothing wrong with this index. This index is telling us that the market is consolidating for another move higher. All it's doing, and when I say the market, meaning the financial sector, what this is doing is it's just eating time off the clock, letting home base or the 20-period moving average come up into price, and therefore this market is setting itself up for another move higher. As you know, the financial sector is going to lead the market, or at least be a participant in the market on both the up and the downside. The market is unlikely to have any kind of a big hard sell without the financial sector participating. And right now, the financial sector is telling us there's nothing wrong with the market. When we look over at a weekly chart, for example, there's nothing wrong with this. It's overbought, but it's absolutely in a bullish uptrend. Nothing wrong whatsoever with this market. Maybe it needs to consolidate for another 2, 3, 4 weeks. But in reality, there's nothing wrong with this market. And even if it consolidates sideways to even slightly lower, that's healthy for the market and would be setting up for another move higher. Switching over to the gold market, gold is having trouble closing above this red candle high that we talked about. The high comes in at 1266.80. Yesterday's close was 1265.50, and we're below that level right now. We have overhead resistance in that the 20-period moving average is sloping down into price, and you have the makings of what I like to call a pseudo doji candle today. We'll see how it finishes out at the final close. I don't think there's anything materially wrong with the gold market. I think it just got severely overbought over the last several days from the low it made on the 12th of December, and therefore it's just taking a quick breather. Maybe it consolidates sideways for a few days. Maybe it has another pop higher, but I do think that we're destined to get up higher in the gold market, at least to challenge in and around this area of this red candle high, which comes in between or in and around the 50 and the 200-period moving average. We talked about this last night. Nothing's changed, in my opinion, in the gold market. Let's flip over to crude oil. I'm skipping silver tonight because I don't think anybody really cares. In crude oil, that we're today above the 20-period moving average. We talked about this last night. I said that was an important and critical area. We need to close above that area as the first sign or first indication that we can go higher right now in crude oil. We don't have to go higher right now in crude oil. We can certainly consolidate for a while longer. But if we get above, stay above on a daily chart closing basis, the 20-period moving average, that'll be an indication that there can be higher prices. all we're really doing is going sideways. And when you look at the weekly chart, you can see here that we're just consolidating inside of this candle that is the closing week of 11/24, which is November 24th, the week of, and we're just consolidating sideways in that candle. The critical level, we talked about it last night, is 55.79. Any weekly close below that level, and that would be trouble for the crude oil market. But what this is doing is, as long as we stay above on a weekly closing basis, that number, 55.79, that's the low, then we're setting up for another push higher in crude oil. The longer we consolidate underneath this $60 area, the more likely it is that we can go higher than $60. Why do I bring that up? Because your high pivot here is just over $60, and that's right above where we are now. So you'd see where we had a high pivot, we challenged it, we didn't quite make it, we came up short, we tried it again, came up short, and here we are one more time, and if we can consolidate for a while beneath that $60, and I think it's 32 or 38 cent area, then it's the market's way of telling us it's trying one more time to build some energy to bust through that area. I don't think it's ready just yet. I think it needs a little more time to bake in the oven, but this is what I'm keeping my eye on from a longer term crude oil chart. Back to the daily, still in an uptrend, nothing wrong with this market, still trending in the upward direction from bottom left to upper right, as they say. Here's the bond market, and the bond market got really hammered today. There goes my case, at least in the short term, for higher prices. This 200 period moving average has to hold. We have to put in some kind of a bottoming signal or reversal candle, and we've got to get back up in short order over these moving averages in order for my bullish case to hold true. Right now, the important level is down at this bottom area where we tested a number of times. You had a low put in here, you tested it here, you have the 200 period moving average, and if this can come down to this level and bounce off with any kind of velocity, that will be a good sign as long as we can get above the moving averages I just discussed. But if we can't do that and we start to break lower, all bets are off and have to reevaluate the picture in the bond market. So we'll move on to the dollar, and in the dollar, we're just going sideways. We didn't have much of movement today, down 0.2%. You can see we're making a bearish pattern here, but we're staying above the 20 moving average, more importantly, the 100. So again, still in the middle of a range. You can't get any kind of a read on the dollar from here, whether it goes higher or lower. I mean, I can make a case both ways, and that's why you do nothing when you can do this. We can make a case that we have an ABC pattern developing. A leg up, B leg down, and C leg up, and we just haven't really got into the C leg yet, any kind of momentum on the upside. That's one case. I can also build a case from a shorter term perspective that we have this down move, and inside of this down move, we're building a bearish pattern that will likely have another down move. And if that happens and we get below and close below on the daily chart, the 100 period moving average, that'll mean lower prices for the dollar. They'll want to test these double bottom lows from down here. And then if that doesn't hold, then we go all the way down here. And when you can build a case in both directions and the picture is not crystal clear, at least doesn't have a high probability for a move in one direction or another, the best thing to do is nothing. So I'm just reading the chart, telling you what I see, saying we're in the middle of a range and the picture's not clear, so we do nothing. And with that, it's everything I wanted to and intended to discuss tonight, so I'll give it a wrap here. I'm David Frost, My Strategic Forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.